Greetings once again. So this will be our next series for section 2 winter, the twigs. Okay, so before this is actually a follow-up of the previous topic, the branches. So I actually suggest all of you actually watch the previous or study the previous topic first, the branches. Only then you should go into this topic. So basically what you are going to understand and learn in this topic are ratios and fractals, okay? In other words, we will go through the most basic form of ratios, which are the Fibonacci retracements, okay? So we'll talk a bit about retracements, okay? So we call retracements, we actually redefined it, not redefined, we actually generalized all forms of retracements such as consolidation, corrections, pullbacks, rallies, or whatever you want to call it. We will categorize it as retracements. Okay, and in this topic, we will explain the logic of ratios, the Fibonacci ratios in terms of buyers divided by sellers, stop losses, and in terms of liquidity, and a bit about fractals. However, this is just an introduction, and we will extend this and explain it more thoroughly in section 3. So you can actually search for this topic in section 3 if you want to. So the main question that we actually want to ask here before we actually begin is, what are ratios? What are the Fibonacci ratios all about? And you will actually find, and there's actually quite a lot of definitions on what the ratios are all about, the Fibonacci ratios, and a lot of them will actually say that it is another form of support and resistance. So very similarly to moving averages and so on, the Fibonacci ratios actually come as a form of confluence, okay? So maybe most probably you have your support and resistance at a particular level, and it so happens to align with the 61.8 retracement, for example, and that is your confluence, that particular support and resistance is a significant one, where that doesn't actually make sense, all right? Okay, let's first begin. Where did the Fibonacci ratio come out from? Okay, an interesting fact is that the founder used this calculation to identify the population of rabbit groves. After noticing a pattern in the grove, there was a ratio identified, and it is the infamous ratio 1.618. Okay, so this ratio, actually, if you actually study this ratio, it's very interesting, where that a lot of things, it can be applied to many different areas: nature, growth, design, whatever, and including trading. Okay, and there is this interesting fact. Okay, this is off topic, it doesn't have to do with trading. However, it's an interesting food for thought. Okay, so I mean, pretty much all of you have heard that of some sort of disaster movie, end of apocalyptic movie, where they say that at the end of mankind, the earth will be either underpopulated or overpopulated. However, there was once, I can't remember where I watched this, where someone actually made a video about the earth will never be overpopulated because of the Fibonacci ratio. I didn't know how he actually did his calculation. However, it's the number of deaths divided by the number of births, and like with the people that are still alive, however he did the calculation, and it turned out to be 1.618. So he actually explained that currently in the world now there's about 7 to 8 billion people, and for the past few decades the number has been maintaining at 7 to 8 billion. So if we were to actually identify if we were to actually say the earth will be overpopulated, and we actually use the same calculation on how humans actually populated the earth over a certain period of time, we should be at least 20, 30, 40 billion, I don't know. But because of the Fibonacci ratio, we maintain at 7 to 8 billion. Okay, I don't know how true this fact is. I don't even think it's a fact, it's just a theory, okay? So we talk about theories. So this is why in section 3 I actually made a theory about the Fibonacci theory. So what is the Fibonacci theory or ratio all about? Is this an indicator or is this a tool? Okay, it is normally, a lot of people actually categorize the Fibonacci retracement tool as actually an indicator. It's not an indicator, okay? The reason why people actually assume it is an indicator, it's because they are using the Fibonacci ratio as a buy and sell signal. How do they actually use it as a buy and sell signal? If prices head towards the 50% retracement or the 61.8 retracement, they will actually use these ratios to try and search for entries. This is why it becomes an indicator, but it's not to be used as an indicator. Okay, so previously I actually showed you guys that there's many ways you can actually use this tool. Okay, so previously if you actually head to the website, you can, in the gardens, you can actually find out that we actually modified the Fibonacci retracement tool to be a risk to reward ratio calculator instead. Okay, so we can quickly identify our risk to reward ratios. So this is just another example. So what are retracements? Okay, so many people actually have all sorts of definition for retracement. Some people will actually tell you that it is when prices start losing momentum. Some people say it is when prices try to trap the traders, and some people will actually tell you that, oh, it is when the market wants to grab more liquidity. While they are technically true to a certain degree, they don't actually define the whole concept of it. Okay, so let's actually start from, you can actually read here the bullish and bearish example over here. For bullish, it can be corrections where high impulsive moves or quick moves or so-called corrections in order for another move to actually happen. So these high impulsive moves, they will have corrections. However, these corrections are very minor corrections. Okay, I don't actually want to call it a correction because the market does not need a correction. The market moves perfectly as it should be. Okay, there are no corrections needed, but for the sake of this topic we will call it corrections. Okay, so this is when high impulsive moves or imbalances, as we prefer to call it, imbalances actually happen, and prices will actually make a very short stop. Okay, these corrections, so-called corrections, could be a supply or demand base. Okay, then you have the pullback, which is the real major retracement. Okay, this retracement can fall back up to 30%, 50%, or 61.8%, whatever percentage it wants to fall back, as long as it can grab the orders. Okay, and finally consolidation, where most people actually call it the death of momentum. Momentum is finally momentum of the move has finally stopped. Okay, so technically this is also, it is correct to a certain degree, but we prefer to call consolidation a form of accumulation and distribution. Okay, so what we actually want to explain here, you can actually continue and read all of this for yourself, but everything about what you have been taught about the Fibonacci tool is actually incorrect. But what we actually like about the Fibonacci retracement tool is that it reduces the amount of breakout traders. That's the best thing the Fibonacci retracement tool has done. Instead of traders looking for prices to break out of support and resistance, they wait for prices to head down to a better price. Okay, a better price, hence the retracement. Okay, hence the ratios. So what is the logic of ratios? Okay, we all know that prices actually move. Okay, not everyone knows. Okay, currently, if you have gone through my previous videos in this series, you will actually know that the market moves because of supply and demand. In other words, the ask and bid. So when the ask and bid comes into agreement, where buyers and sellers agree to buy or sell from one another, this actually creates liquidity, okay? And this liquidity is actually orders, okay? An accumulation of orders to actually buy or sell, okay? So what can actually happen next is consolidation or retracements, okay? And this can come in the form of corrections in which prices may require reaccumulation or new orders or manipulation or whatever the institutions can actually do to collect more liquidity. And when liquidity is there, the process actually repeats itself again and again and again. Okay? So this is what the Fibonacci retracement tool actually did right, okay? So, but the problem with all of this is if you actually have this diagram in front of you when actually you are using the Fibonacci retracement tool, instead of making a decision based on a magical number, instead of making a trade like, okay, it's the 61.8 retracement, it's the golden ratio, so I'm going to make a trade at the 61.8 retracement. Instead of doing that, if you actually have this in mind and you ask yourself, prices are coming to the 61.8 retracement, ask yourself, where are the orders? Where is the order of accumulation? Is this re-accumulation? Is there liquidity? Okay, so the whole idea is that we actually want to emphasize to you and teach you all how to actually look and identify where liquidity is actually located. Okay, so before we actually head on further, let's talk about Fibonacci ratios, okay? So I don't want to talk about too much about this, but you can actually read what is in front of you in your screen right now. But what I actually want to talk about are the three major retracements, okay, which are the 38.2 retracement, the 61.8 retracement, and the 50% retracement. Okay, so a lot of people will actually say, oh, when prices retrace to the 38.2 retracement, this actually shows that prices are going in a very strong trend. It is high in momentum. And if prices retrace to the 61.8 retracement, they actually would say something like, oh, this is actually, prices are in a healthy trend, okay? Or they will say something like, prices are not high in momentum, or this is actually a stop hunt, or whatever they want to call it. And the 50% retracement is actually in between the 38.2 retracement and the 38.2 retracement and the 61.8 retracement. Directly in the middle is the 50% retracement. So a lot of traders, they don't actually know, will prices bounce off the 38.2 retracement, or will it bounce off the 61.8 retracement? And they have come to a crazy conclusion. The conclusion is, let's just pick the 50% retracement since it's in the middle. Okay, so this is the problem with trading the Fibonacci ratios. You're actually using numbers that don't actually make sense. You are picking out random numbers and you're actually trying to find for confirmation signals. You're trying to find for confluences. I mean, all these numbers and ratios were actually made up. Okay, it was actually made up in the chart where you have this tool. Someone, I don't know who, actually said that, oh, the 61.8 retracement, that is a very powerful tool, that's a very powerful level, and prices during our backtesting, prices actually made so much profits from the 61.8 retracement. Okay, I've heard a lot of people say this and they are wrong. Okay, so what I actually want to conclude here is that just like support and resistance, okay, think about what we actually spoke on earlier in the previous videos, okay, supply and demand, it can be support and resistance, but support and resistance cannot be supply and demand. It cannot be the orders. The same applies here. Okay, supply and demand can be located at any one of the ratios. However, the ratios cannot be supply and demand. Okay, so let's go on to understand, not basically to understand, we'll just give you a rough understanding, a very basic one. This, you can actually find it online, but what we actually want to tell you right now is how we actually try to redefine it so it somewhat aligns with supply and demand. Whether you realize it or not, this is the best way you can actually use it. Okay, so let us begin. Okay, we are going to start from the last area of support. Okay, what is the last area of support? It is entry number 4. Okay, it's not entry number 4. Look at the 100% level. Okay, the 100% level, prices climbs up. Okay, it climbs up all the way to the 0% level. Okay, and the 0% makes the resistance and the 100% makes the support. Okay, so when prices actually move down, it moves down to the 38.2, so this actually marks a small retracement. The 61.8 actually talks about higher collection of liquidity, and the 78.6 actually it tells you that there are more liquidity, that it actually tells you that more liquidity is required, more orders are required to actually move the prices up. Okay, so this is everything that you're going to read here. Is actually a rough and basic understanding on how Fibonacci retracements actually can be used in the layman's term. Okay, however, after reading this, you don't have to, we suggest and we recommend that you go directly to section 3 and look for the Fibonacci theory to actually extend your knowledge on retracements, ratios, and also fractals. Okay, so basically this one is also the same thing, only that it is the opposite, a bearish trend instead. And let us get into a session. Okay, so this session is actually quite simple. You can actually see right here the charts, and we actually have drawn two Fibonacci retracements. Okay, one is for the down move and the other one is for the up move. Okay, so most of the time, once people actually place in their Fibonacci retracement tool, they will actually try to identify higher highs, higher lows, low lows, and low highs, or whatever they want to call it. Okay, then after that, they will actually try to mark out their support and resistance zones. Okay, upon identifying their support and resistance zones, they will then try to identify how prices will actually move, how prices will actually bounce off all these Fibonacci retracement tools. And there are times where they get really lucky, and because they got really lucky, they made a lot of profits, and they start telling everyone that, oh guys, look, we actually made a lot of profits just using the Fibonacci retracement tool. It's the only tool you need. Okay, wrong. Okay, don't actually use the Fibonacci retracement tool this way, because you will run into quite a lot of problems. But I want to explain, I want to go further. I don't want to talk too much about the Fibonacci retracement tool, because I don't want this topic to end up a topic where I talk crap and bash indicators or tools or whatever is in your trading platform. However, I just want to re-emphasize that it is not about searching for the perfect retracement. I mean, it's all about identifying where the orders are. Okay, but what is the true logic behind the Fibonacci retracement tool? The true logic behind the Fibonacci retracement tool is actually equilibrium action in fractals. Okay, so it's all about rounding off. Okay, rounding off to the big numbers. Okay, a lot of people, sometimes you actually notice that when people actually give trading signals, they like to say, okay, I want you to buy at 1.29900 da 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 da, I don't know. Okay, do you actually think that if you were to be, okay, I'll give you a simple analogy, but it's not literally like this in the market. Okay, if I were to sell you a can of beer, okay, so I tell you this can of beer is $3, or should I say that this can of beer is $3 25 cents. Okay, so of course you make a profit of the 25 cents, but that's not the point of this analogy. The point of this analogy is it is easier to say 3, it's easier to round it off. Okay, it's easier to key in. Okay, so why I'm actually showing you this, it's because I want you to understand a bit more about fractals. Okay, if you actually look at this, what I want you to do is to quickly identify two levels. Okay, the first level and the second level. What are these levels? These are typical support and resistance levels. Okay, so the number, okay, what I want you to do next is you can actually take, if you take level 1 and level 2, the price of level 1, you minus it, okay, you minus it with level 2, you get a fraction. Okay, and level 2, you minus it with that particular fraction, you will get level 3. And you repeat the process. Okay, level 3, you minus it with that fraction and you will get level 4. And all these levels are equal in length. Okay, because let me put it very simple. 1 plus 1 is 2. 2 plus 2 is 4, right? 4 minus 2 is 2. 2 minus 1 is 1. Okay, it's fairly simple. You cannot have 1 plus 1 equals 10. Okay, so prices actually move based on how much liquidity is taken. If there's $100 of liquidity, are you trying to tell me that prices are going to move 1,000? Of course, it will move in the $100 range since there is $100 of liquidity. This is just a minor and rough example. So if I were to actually flow this chart through, you can actually see how prices react to all those levels. Okay, so technically we did not draw support and resistance. We were just drawing fractals based off the Fibonacci ratios. Okay, so not literally the Fibonacci ratio, but what we're actually trying to explain here is that this is how the Fibonacci retracements actually work through fractals. If you were to actually align your Fibonacci retracement tool with the fractals, it will work much better. Okay, however, it's still not recommended. So this, we have come to the conclusion. Okay, so now you know about technical analysis, you know about identifying support and resistance and most of the major indicators and so on. You understand the golden ratio and you understand fractals. And if you study this topic once again, you will also identify how you can actually use the same tool, this tool, to target your levels, target your stop losses, and also find significant levels. Okay, so although we will actually go on further later on throughout the series to emphasize on how you can actually use this tool to your advantage rather than randomly taking numbers that someone in the world actually gave you. So we're actually not going to tell you that there is no ratio in the Fibonacci ratio that works. Okay, there is no one ratio that works because all these ratios were actually predefined by someone's backtest. Okay, it was predefined by someone else's backtest. It might work on one pair, but it won't work for the next pair. But if you can identify where the orders are located, it is the same and the way. For this topic, I'll see you in the next one. Same all across. Alright, that's it for this topic. I'll see you in the next one.